Your financial product moves money across multiple systems: payment processors, banks, digital assets, custodians. Each holds its own records, its own version of the truth. But you don't. Without a single source of truth, tracking funds, reconciling mismatched timelines, or producing a clean audit trail becomes a manual, error-prone process stitched together with spreadsheets and logs. Formance is a programmable core ledger that unifies every system money touches. Build a complete chart of accounts, connect your financial infrastructure, and instantly trace funds across the payment lifecycle with a full audit trail and no manual reconciliation. Formance, the unified ledger for the hybrid economy. Find out more at formance.com.
Welcome to Fintech Insider Insights. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. Treasury has traditionally been seen as a control function, managing cash, safeguarding capital, and reconciling transactions behind the scenes. But Treasury is the only function that can actually move money across organizations. And in a real-time, platform-driven economy, that power is becoming strategic. On this week's episode of Fintech Insider, in partnership with Adyen, we're going to explore what happens when money movement becomes a competitive advantage. To help us do so, I'm joined by two fantastic guests. First of all, we have a Fintech Insider debut for Adrian Davis, Managing Director of Financial Services and Insurance at Adyen. Welcome. Can you tell us a little bit about you and your role at Adyen, please?
Sure. Thanks for inviting me, Benjamin. As the title might suggest, I'm responsible for our financial services and insurance market vertical within Adyen. But more recently, I've also been taking a lead in the commercial development of some of our banking and treasury and liquidity management services that we offer our customers.
Fantastic. Thank you. And I'm also delighted to welcome Stanislas Nowicki, and I'm sure I've got your name wrong there, sorry, I should have checked that beforehand. Managing Director and Partner at Boston Consulting Group. Welcome, Stan. Could you also tell us a little bit about you and what you do at BCG?
Sure, thank you for having me. At BCG, I work at the intersection of finance and technology. My job is to help large enterprises and their C-level executives deliver more value for shareholders and for society. And as part of that job, I work with finance function leaders to multiply their impact.
Fantastic. Okay, well, let's dive in. So we want to start this episode by asking whether digital technology is driving a structural shift in sort of corporate treasury. Is treasury moving from operational oversight to a strategic enabler? Stan, for listeners who might not be that familiar with Treasury, what is Treasury and what has Treasury traditionally done within large organizations?
Well, at its simplest, Treasury is a finance function which role is to ensure that the business has the right amount of cash in the right place at the right time. And of course, this function's role is also to ensure that the corresponding risks are well managed. Traditionally, that was enough. But today, treasury functions need to look forward and think where to bring the cash next.
Adrian, from your perspective, working with sort of global corporations, are you seeing the same thing about what's sort of starting to change in treasury today?
Yeah, very much so. I think particularly with some of the large global enterprises that we work with, I think a few new trends and drivers are notable. Particularly the speed that business is moving these days, which is in no small part dictated by the needs of the customer in a competitive market. I think if you look into a variety of different sub-verticals, for example, brokerages or insurance, then the customer's demanding payment a lot quicker. To be competitive, you need to transfer money a lot quicker. And I think that businesses are looking to gain competitive advantage by satisfying that customer need.
It's not just customers, though, is it? Because it's also presumably suppliers, employees. I mean, we spend quite a bit of time at 11FS talking to small businesses, and they're always complaining about large businesses paying them slowly. So you're right, the pressure's coming from customers, but it's not just customers, correct?
No, that's right. And I think, some enterprises will seek to speed up that flow of payments if there's a good need to other suppliers or other partners. Or they may choose to slow them down because they want to make money from the return on the float that they have. So it really does depend. But I think in today's modern environment, you're seeing a lot of different dynamics that a treasury team is having to deal with. I'll give you one small example. If you work in the delivery or mobility space, it's actually really important to pay your couriers or your delivery drivers quickly, because if you don't, they might choose to go and work for the other delivery company. And it's dynamics like this that never previously existed. That's a competitive advantage if you can keep good labour by paying them effectively, quickly and accurately.
So speeding up payments, Stan, I mean, that sounds simple. That sounds easy. It sounds like a good thing. Though I take your point about you might want to earn money on the cash. But how easy is it to start actually speeding up Treasury? Because presumably Treasury has exactly the same kind of legacy issues that pretty much every other organization or every other department has.
Absolutely right. And when we work with large organizations, what we see is that a significant portion of them operate their treasury processes like in the last century. There is still a lot of manual work going on, and the layers of legacy complexity have accumulated, which makes it even more difficult to change. That being said, there are a number of forces that are all pulling into the same direction, and that I think signal that treasury is at an inflection point. First of all, a lot of technology innovation has happened in the last 10 or 15 years. Think of faster payment rails or API-based technological infrastructures that allow to do things that were not possible a couple of decades ago, like making payments instant. The regulators are also looking into that direction of enabling more instant payments. We talked about business model evolutions that is going to a more ecosystem logic. And at the point of our discussion today, there are also liquidity pressures that are encouraging companies to make payments faster and more efficient.
So coming back to the point you were making a few minutes ago, Adrian, about how companies want to pay their sort of workers faster or reimburse customers faster and so on, depending on the industry they're in. Does that mean that the payment actually becomes part of the product experience, where previously finance was sort of in the background, and now actually, product teams are starting to go to finance teams and saying, you need to fix this?
Yeah, no, I think that's a key observation. And this is exactly what came out from the research that Adyen and BCG did. We spoke to over 300 treasurers and CFOs about this very issue. Things are changing. The operating model that Stan just mentioned is probably 10 or 15 years out of date. And I think what we'll go on to talk about, I hope, is how the treasury teams can reframe their mission. Because they're not just there as a reactive part of the business. Their influence can stretch considerably. If I just go back to the point I made about paying delivery drivers very quickly, what we often find with some of our customers is they seek to premiumize that. So in other words, they charge a fee for paying the money they owe quicker. But the delivery drivers or other suppliers are quite happy to pay that because their cash flow dictates that trade-off makes sense because they get that cash quicker. And I think when you start thinking about concepts such as that, then you can see how the treasury team is actually driving more value than they were in their traditional role. There are ways of increasing new revenue streams that previously or hitherto might not have been considered.
Are you seeing, Stan, are you seeing similar things in other industries? That's a lovely example of delivery drivers. But are we seeing similar patterns in, the travel industry or the insurance industry or other industries where you've got customers or you've got suppliers who are saying, we want the money back faster, turn it around for us faster?
Absolutely. And I think that's an essential point. Treasury is very vertical specific. Adrian mentioned this example in delivery, but if you look at marketplaces, for example, have a constant trade-off between seller settlement times and optimizing their float. If you look at online travel agencies, they have a working capital issue to fix. If you look at insurance companies, the faster they pay their claims out, the better net promoter scores they get. So in every industry, you can find a little bit of a different innovation angle, but certainly a need for improved treasury services.
One of the things we haven't touched on here is sort of cross-border money movement. In thinking about the travel industry, you immediately start to think of that. But of course, for many corporations, in fact, most corporations are operating across countries. So presumably one of the challenges is you've got a pool of dollars here and you've got a pool of euros here and you've got some yen and you've got sterling and some renminbi or whatever. How does that get faster or better? Because presumably part of the trouble for many treasuries is there is cash, it's just in the wrong places and or in the wrong currencies, so on. Is that part of the challenge facing many treasurers is like cross-border optimization?
It is. And what you've described is really complicated.
I know, it sounds easy, doesn't it?
But, it's only one layer of that complexity, because sitting under all of that, you've got lots of different banks that are required and often, or have been historically, in those different markets. So there's a huge interplay, not just in terms of FX, but in terms of banking partners, in terms of fintechs that you might be using as part of your ecosystem of suppliers that are using someone else's bank account. It can be really complex for large global enterprises that have grown over a period of time because they've just accumulated a lot of this complexity.
So what does this mean for sort of some of the individuals, the chief financial officers, the treasurers, the people in their teams within large companies? Are they sort of drowning in manual work, fighting against these legacy systems that don't give them the information they need? Or are they gradually winning that battle and sort of becoming strategic? I'm sure there's companies all the way around the spectrum, but where are companies sitting today?
That's a really interesting question. When you look at the role that treasurers and finance professionals more generally are playing in large enterprises, they historically have a dual role. We like to call it, for treasurers, the morning treasurer and the afternoon treasurer. The morning treasurer is all about getting the most done at the fastest possible speed, operational tasks, get it quickly through, while the afternoon treasurer focuses on more strategic tasks, midterm projects, business value enhancing projects. And with the new possibilities that next generation treasury offers, you can rebalance that mix from roughly 50-50, as our research recently demonstrated, 50% operational, 50% strategic, to much more strategic tasks and higher value-adding interventions from the finance teams.
So more of the sort of afternoon work and less of the morning work. Does that mean everyone can go to work later?
But it is a real issue because, again, the research bears this out, that for your average CFO or head of treasury, 20% of their time is spent looking after pay-ins and payouts. And then if you take that activity, 20% of that 20% is actually making manual interventions on those pay-ins and payouts. So, it's not a very automated world for many enterprises out there. And so there's considerable scope to remove some of that complexity.
Just to bring it to life for a minute, what sort of thing is a treasurer or a CFO doing in one of those pay-in or payouts? Is that where there's sort of an unusually large payment, let's say, that needs approval? What is it that needs to be done? What's the process? Or is it just something that's just the money hasn't arrived, it hasn't gone, there's a problem somewhere that they're trying to figure out? What sorts of things are gumming up the system?
Well, I mean, I'd suggest that it's really quite basic hygiene factors that just go wrong. So, for example, if I'm an insurer, I have a modern digital checkout, I offer many different ways of paying to my customers, then you would expect a large proportion of those acquired funds to go through the system, to be no issues. But if you don't have a reliable payment services provider, things go wrong. And at best, that means someone calling the call center or having to make an exception around a particular payment. At worst, it could be people driving around thinking they're insured when they're not, and having to chase the customer. But whenever the system goes wrong, there's a disproportionate amount of effort that needs to be made by the finance team to recover the situation. So in theory, at least, it's better to eliminate those edge cases by having a modern payment stack to enhance the input of the payment coming into the treasury team in the first place.
I would add that the provider setup complexity is multiplying that difficulty. In our research, we showed that the average large enterprise has 12 pay-in and payout providers, has 4 or 5 banking relationships. That translates into 40 plus bank accounts. So even relatively basic activities like visualizing accounts or managing relationships, not even talking about handling payments and exceptions, are consuming a considerable amount of time for those finance teams. While if you fast forward and you think about a more streamlined, optimized, automated process, most of these activities with today's technology could be largely automated and focus the human time on the really difficult cases.
Yeah, it's for a modern treasury team, it's quite easy to have that UX that sits above all of this, that provides nice visualization of the current cash situation in the business. But it's only ever as good, as elegant as the plumbing is. And Stan is quite right. There is a huge degree of complexity with the number of bank accounts, banking providers, and fintechs that many of the organizations that we work are dealing with. That causes a problem, not just from a kind of risk perspective, because if you're sitting on a risk committee, you want to be certain of those banks that you're dealing with, and have resilience built in there. But the cost of maintaining those suppliers is significant. But the biggest issue of all is the trapped cash that sits in each part of the process with a different bank. And this is what we're finding with our customers, that when you sit down and map out those flows, doesn't matter whether you're a business that wants to pay quickly or wants to pay slowly and make the most of that float. The reality is a lot of that money is stuck in a third party for even if it's just for a few days, but the cumulative effect of that can be many days. And that is what causes additional pressure on cash flow, which is costing companies dear.
Because that trapped cash isn't earning interest, it isn't improving a customer experience.
Well, not for you anyway.
Yeah. Or, yeah. Yeah. And of course, presumably that's also, there's a cross-border element to that as well.
Yes.
That, part of the reason cash sometimes gets stuck is those cross-border flows are slower often or more complex and so on. But coming back to this point on visualization, right? So, we can all imagine this sort of wonderful dashboard that shows you all the cash and all the pools of cash and where it's all trapped and so on. And I'm sure there are many people out there trying to build exactly that. But presumably a big part of the problem is that among those average of 40 different providers that a typical corporation might have, you've got some that have got some fantastic digital tech. They've got some, brand new APIs, really well documented, all complying marvelously to the appropriate standards. And then you've got others that haven't. Is that part of the problem as well? That just
spot on. So 50% of the respondents we interviewed as part of our joint research with Adyen mentioned that they still rely on host-to-host integration. And that is really not making the job of automating and even bringing information into one place.
Half of them have got a host. Is that host-to-host in just sort of one of the relationships or across? I suppose we don't know.
Typically across, given the number of providers that they rely on. And I think that gives a sense of the tough job that it represents to bring a unified view of a company's money. And even in those cases where automation is really good, when you talk to executives and ask them, what's the actual coverage of your dashboards, of your automated solution? It rarely gets up to 100%. So you get this nice, fancy dashboard that looks like a consolidated view, and then there are exceptions, things that you need to add manually, build Excel spreadsheets around.
Because there's a partner, a provider, or a number of players in the chain that just can't give you that accurate data or the real-time data. Presumably, some of these dashboards are looking at batch data or yesterday's data. So
Exactly.
Think about what it does to forecasting, for example. You asked earlier how could the situation be optimized, and what are the typical activities of treasurers and CFOs. One really important one is to get visibility on how is liquidity going to evolve in the coming days, hours, minutes, and that is barely impossible to do when only part of the information is consolidated in one place.
Is there a difference between companies that mostly serve consumers and companies that mostly serve businesses, right? Because there's different power dynamics, there's a different interplay. Did you find in the research any sort of well, you talked a bit about different sectors, and obviously different sectors have very different rhythms and payment periods and so on. But did you notice any differences between corporations that mostly serve other businesses and corporations that serve consumers? Is it kind of easier if you serve consumers because you can just say, right, these are the terms, you have to comply? Whereas when you're dealing with businesses or government, there's a little bit more negotiation. Is there a difference there?
I think when you're dealing with consumers, there is an additional opportunity. If you think about it, the full payment process from paying to payout is a continuum, right? And that step in between that we call treasury, which is really managing money while it's there, is part of a longer chain. And when you are serving consumers, you have the opportunity to have a full visibility from the beginning towards the end of the chain, and be able to reconcile where those flows come from, where they are in this process, and make a full end-to-end optimization.
So you're saying it's easier in a sense if you're mostly serving consumers,
yes,
than if you're serving businesses,
provided you have the right partner.
We see both sides of it. Much of Adyen's heritage is within large enterprises, but we also have a very successful platform business that are a kind of vertical SaaS model, if you like. It will be serving a bunch of SMBs. But the pressure doesn't go away there. The demand doesn't go away there. Settlement needs to be immediate. Payments need to be immediate. There still needs to be an element of this real-time treasury there as well.
Okay.
Maybe to add one point, I think it's important to note that customers do not think in settlement cycles, right? They think in their day-to-day experience, and consumers have been used to very much improve digital solutions in their day-to-day lives from a B2C standpoint, and now they expect the same in their interactions. And finance professionals are the same. They got used to using next generation applications and get information instantly. Why can't they have the same in their professional lives?
Last quick question for you, Stan, in this section then. Are treasurers sort of winning that battle to do more of the afternoon work, more of the strategic work, or are they still very much getting dragged back into that morning work, looking at pay-ins and payouts and problems? So are treasurers winning the battle?
I think we are very much at the beginning of this process, and I think one of the points in our research is that treasurers and finance teams can do much more to contribute to the business objectives of the companies that they work for. The technology is there, the solutions are there, the regulation is there. So now it's more a matter of reviewing the status quo, questioning it, and designing for a better future as if you were building the processes and systems today.
Fantastic. You've just wrapped up the first half very well for me. So we wanted to sort of explore how treasury is becoming more strategic, and you just summarized that really well. So in the second half, what we want to do is sort of explore a little bit about what's making that shift possible, how it can be done, and how treasury teams can embrace a new approach to infrastructure and partnerships to try and become that more strategic function. So we'll just take a quick break and we'll be back very shortly.
LifeLock, how can I help?
The IRS said I filed my return,
But I haven't.
1 in 4 tax-paying Americans has paid the price of identity fraud.
What do I do?
My refund, though.
I'm freaking out.
Don't worry, I can fix this.
LifeLock fixes identity theft guaranteed and gets your money back with up to $3 million in coverage.
I'm so relieved.
No problem. I'll be with you every step of the way.
1 in 4 was a fraud-paying American. Not anymore. Save up to 40% your first year. Visit LifeLock.com/podcast. Terms apply.
As a chef, I know flavor doesn't begin in the kitchen. It begins on the land. And Westhome's nature-led Australian Wagyu is a story written in the landscape of Northern Australia. Cooking is storytelling, and Westhome Wagyu carries a story of Northern Australia itself. Raw, powerful, and deeply authentic. It's a testament to the passion and care raised in the rhythm of Northern Australia. I'm Chef Maylin from 88 Club in Los Angeles, and I invite you to visit westhome.com/Maylin to learn more. And taste a story only Westhome nature-led Australian Wagyu can tell. That's westhome.com/MEILIN.
Welcome back to Fintech Insider, where we're talking about the changing landscape of treasury management. So let's kick off the second part of the show by talking about sort of some of the causes and costs of fragmentation in corporate banking relationships. So both of you talked a little bit about it already. But Stan, maybe it's worth just sort of going over that again. So you were talking about how many corporations have multiple banking relationships. Presumably that's partly because they're operating in multiple countries, but they also have several in each country, presumably. What does that actually sort of look like in practice? Do most corporations have just one bank in each country? Do they have multiple banks? What's driving those 40 plus relationships?
So what we typically see is that large enterprises tend to have what we call a house bank in their country of origin or in the headquarters. And then they have a multitude of banking partners that serve a specific purpose that can be covering a specific geography or providing a certain set of advice or technology. I think we also need to recognize something that is maybe a bit of a contrarian view, which is that not all complexity is bad. There is a part of complexity that is intentional. If you think about resilience aspects, or if you want to create a level of competition between your providers, one may understand that you could have several providers in your ecosystem. I think the part that is really problematic and that treasurers need to address is that unintentional complexity, that this layered on legacy that is slowing them down, and that is making it impossible for them to operate at the maximum possible speed. Some call it complicatedness, unnecessary complexity.
Yeah, I completely agree with that. I think that at the time, many of those decisions were entirely logical. You see many enterprises that have a wide variety of payout providers. But at the time, the supplier base dictated that you might need individual payout providers in individual domestic markets. But the market's evolved. This is an operating system, as I say, that was taking place 15, 20 years ago. Today, there are many more modern global technology providers that can provide the same level of services across a number of different international markets. But I think most CFOs and heads of treasury would concede that if they took a step back from the stack that they've created, that none of them would design it today in the way that they have, that it's emerged, and the cumulative impact of that complexity. It acts as a brake on their ability to innovate, a kind of tax on innovation, if you like.
I feel like we might be talking about two slightly different things here, which are both important. Because when you're talking about payout providers, I'm thinking in terms of maybe sort of payment services providers. Maybe I'm operating in Germany and I've got some customers who want to be paid in cash. I've got others who want, credit card refund. I've got others who want a debit, and maybe I have a variety of different partners that I work with, because actually there's customers who just want to be paid in different ways, or I'm an insurance company and again, I need to pay different people in different ways. And Stan, part of what you were talking about was, I might have a relationship with BNP Paribas, I might have a relationship with Société Générale, I might have a relationship with JP Morgan, I might have multiple banks, and both they're providing different services. So actually through the stack, I've got a variety of different partners. I liked your point about intentional versus unintentional complexity, because you're right, there might be scenarios where actually I do want to have a relationship with both BNP Paribas and Société Générale, because for the particular transaction I'm doing, maybe I'm doing a big trade in from dollars to euros, maybe I'm getting a better rate from one or the other. So the way it's an interesting balance, isn't it?
It is. And the way I think about it is starting from what the company, the CFO, the treasurer needs, right? Do they need advisory services? Do they need a particular product like FX? Do they need a particular capability, whether it is paying in or paying out? And it's based on those needs and the ability for their providers to fulfill them either as one or as several, that you can design the best possible provider ecosystem. I think what Adrian was pointing to is that originally it was fundamentally different providers who were giving these services to CFOs and treasurers, while in reality today some of these company profiles or providers profiles have blended towards some that are able to provide several of these services at competitive levels. Some even have a bank license. So you don't necessarily need to split every service into a different provider. You may compare providers that are able to provide several versus very specialized providers that provide only certain of those services.
Thank you. So, Adrian, for somebody who's listening to this, who maybe works in a finance team or is maybe a treasurer and wants to be more intentional about the sort of partnerships they have, how do you start going about sort of rationalizing that complexity while keeping some redundancy, perhaps, where you want maybe multiple providers available? How do you go about sort of streamlining and rationalizing that? And I realize that's a big question.
No, but yeah, I think it's a fair one. And I think that this is a conversation that we're having live with many of our customers. I think there is a growing recognition. It's still, as Stan says, it's still at an initial stage in terms of understanding the complexity and the pressure to reform some of this complexity. But when we get into conversations with our customers, and we literally just map out those payment flows and look at where the money is going, how long it's settling for, then who it passes to, then in most cases, you have a very complex whiteboard with lots of different providers. And to Stan's point, if in Adyen we're acquiring the funds and we can do the payouts and leverage our banking licenses, which we have in the UK, the US, and the EU, then you then see how you can abstract some of that complexity away from this constellation of different financial institutions that you're relying on. I don't think anyone's suggesting that you would just rely on one bank. In fact, in many regulated financial services market, the regulator says you must have more than one from an operational resilience perspective. But if you think about the flow of cash through a business, if you've acquired the funds and you can sweep it automatically, T+0, into an account, and then use that to fund the payouts, then you've probably done that 5x quicker than you would do if you had 3 separate providers for that. So again, this is the market and supplier base responding to some of these issues and leading to treasurers considering, is there a better way of doing this?
I like what you said about it's providers responding and not providers inventing something that customers wouldn't look for. Actually, in our research, how treasury innovation drives better business outcomes, there was one particular data point that struck me. Nearly 3/4 of respondents, 74% to be precise, are looking for a more consolidated treasury solution. And this is not something that they were able to find until now. So essentially, it's a customer need. It's an unmet customer need.
What do they mean by a consolidated sort of treasury solution? Because I'm immediately thinking you mean a sort of treasury management platform, but I don't think that is what you meant.
Yeah. I mean an integrated end-to-end money management solution that is able to cover most of your needs, both from a money cycle standpoint, from paying through money management, through payout, and from a geographical standpoint, covering your main countries of presence.
Yeah, I think if anyone says, I've got a silver bullet for treasury, then run a mile, because that just doesn't exist. But I do think that by taking an end-to-end view of that money flow is certainly a way of, that is part of reducing some of that complexity.
I completely take your point about silver bullets. However, to build on what you were talking about earlier, Stan, you were talking about some of the technologies that are enabling faster throughput. So you were talking about APIs, you were talking about real-time payment systems. We've managed to get a long way through this conversation without mentioning agentic AI. But you could imagine that people will start using automation, using better platforms, better connectivity to start creating maybe not all singing, all dancing perfect solutions, but to improve the solutions they have. Is that it?
Yes, and I think the point you made earlier about timing really ties into that. If you think about how payments operate today, in the most frequent case, we are talking about batch payments that are, and you have to wait until they are grouped together, performed once a day, and then you look the next morning at how the situation from yesterday looks like. With the new possibilities of artificial intelligence, whether predictive AI or generative AI, not even talking about agentified processes, you would have a possibility to make those processes individual. I mean, at the individual payment level. Why would you need for a batch when you could do it the moment the money arrives, right? So this may sound a little bit futuristic compared to what treasurers experience today, but fundamentally, the technology enables it today.
Yeah, I agree. I think what's interesting in the context of a treasury operation is that, I think there's no doubt that the market is beginning to develop treasury agents that can be autonomous, that can make decisions, sensible decisions, 24/7, sweeping or pooling funds. But it's only ever going to be as good as the system that you have in place. If you were trying to automate and put a level of intelligence over a system that's very complex and inefficient in the first place, you're not going to optimize the benefits of that new technology.
And there's a lot of money at stake. I mean, as part of our research, we tried to quantify what would be for a large enterprise company the benefit from using optimized treasury solutions. And quite easily, we get to single-digit million impacts for a mid-sized enterprise. So I think there is a lot to uncover there.
It's really interesting. It reminds me of, there was a wonderful case study of the German bond issuing department. This is 20 years ago, and they were very proud of how efficient they were because they only had 7 employees and they were managing the entire sort of debt raising for the whole of Germany, which is one of the biggest bond issuers in the world. Until people pointed out that, well, yes, but if they were a bit faster and timed it a bit better, they could have saved billions, billions of Deutschmarks. And so you're making a really interesting point there because the amount of money at stake here is so big. The amount of trapped cash and the potential for that trapped cash, that it's easy to overlook the importance of some of these processes, isn't it? It's easy to overlook the opportunity.
Yes, and I think there are 2 ways that treasury teams can contribute to actually reaping the benefits of this modern treasury. I think number 1 is directly, right? If you get faster access to funds, and if you can give faster access to funds to your customers, you might be able, in some cases, to make it an additional service. And then I think there is indirect benefits. If you get lower working capital requirements, or if you get your funds earlier to invest, you basically have the opportunity to monetize those funds for yourself, which is in turn making a financial benefit for the company you're working for. So really both those aspects, like directly contributing into the business, finance being part of the customer journey, and indirectly contributing through the treasury expertise, are 2 untapped areas of opportunity.
Adrian, you were talking earlier about sort of marketplaces and business models and so on. How important is having a more modern treasury to succeeding with some of the sort of newer business models, marketplace business models or vertical software as a service and so on? Because in a lot of those digital business models, there is that expectation from suppliers, from customers, of faster money movement, of instant payouts and so on. And also, I know that some of the leading technology companies are quite advanced and sophisticated in how they approach payments. Are we sort of saying, actually, if you want to succeed in the digital economy, you've got to have a digital treasury?
That's a very good question. I think what we find is it does depend. It depends on vertical. It depends on maturity. Through the research we did with BCG, we saw a range of different perspectives on this. You could take a well-established, older multinational enterprise that operates in maybe a low-margin, kind of stable, sort of FMCG type of organisation, which would be very, very sophisticated in terms of managing that working capital and extracting the best possible value out there for the benefit of shareholders. But by the same token, you could be talking to a very modern, hyper-growth technology company that's never really considered working capital as a key metric because it has unlimited funding, its shareholders aren't putting them under pressure, and their focus is about building and growing as fast as possible. So it really does depend. And sometimes the most technologically advanced don't necessarily have the most sophisticated treasury systems.
Absolutely. And I would add, at the risk of oversimplifying, a rule of thumb can be the more you are into ecosystems, the more treasury becomes central, simply because you have a larger number of stakeholders that you need to move money to and get money from. And that makes the role of treasury even more central than it used to be in traditional corporate contexts.
Yeah. That's a really interesting way of putting it.
Yeah.
So how does this sort of change what treasury departments do and how treasury teams operate? Adrian, how does this start to sort of look different within treasuries? What are the sort of more modern treasury departments?
Yeah, this is the really interesting bit, isn't it? I think first and foremost, it's about the recognition is there an issue here, or do we recognise there's a problem in the first place? And if a treasury team or a CFO does, then great. Question is then, what do you do about that? I think as Stan and I have pointed out, and the research backs this up, that in many ways, the treasury team needs a new mission that adapts to the new reality, the demands from customers, from suppliers, but also makes the most of the technology that's available for them and the ever-evolving ecosystem of financial providers that sit out there. And I think if you can redefine what that mission is, I think there's really interesting implications, even for the types of skills you need within those departments as well, because it's not a passive job anymore. That you need to understand technology. You need to be able to understand that whole value chain that leads to the customer and creating the organization creating value. It demands a different type of skill and capability, I think, within those teams.
Building on what Adrian said, I think we spent a lot of time describing how the status quo could be questioned and changed. I think the next layer of sophistication is to quantify the value at stake. Like, what do I have to gain by adopting a different treasury and a different finance mindset? How much can I contribute to the business by doing so? And I think the second aspect is inform the trade-offs. We discussed before that many of these businesses have trade-offs to make. Like, do I keep the money for longer and earn on float, or do I give my customers the money back faster and increase customer satisfaction? If you want to decide on those, you need to know how much each is worth and how you can contribute.
I suppose a possible frustration for some of the finance people listening is that if you're in a company that hasn't really thought strategically about treasury, you probably can't easily quantify the opportunity cost. Obviously you're good at maths because you work in finance, but presumably it's harder to get the data in the slightly less sophisticated companies. Maybe harder to, because this is a really important point, right? How do you build a case for change in your own organization? If you're the CFO, okay, it's your job, but if you're someone else in the team, how do you sort of create that?
Well, I'm not an accountant, but what I would say is that what we see here is that if you can increase the period of time that your money is in play, that you can, so in other words, you can earn a return on the float either by gaining interest or investing in the money markets, then all you need to do is to work out how many days you're extending that by and how much a day's revenue is worth for you, and then the maths is relatively simple. But generally speaking, for the types of customers that we were speaking to, as Stan has already said, it's not a small amount we're talking about here. a couple of days' revenue, the return that you could get on that's a significant benefit that can drop straight to the bottom line.
And I think what you said about the role is also quite important. These findings that we are discussing today are an opportunity for treasurers to move out of a back office-like role and move forward to a strategic, advisory, business-enhancing role. And I think the first thing I would do if I were in the shoes of a treasurer is propose that approach to my CFO and maybe encourage my CFO to look at it in a ROI way rather than in a backward-looking optimization way.
Thank you. Okay, last quick question for you both then. Well, it's quite a big question. How should sort of enterprises think differently about how they structure their sort of corporate finance teams, their partnerships, their infrastructure? What are the sort of what's the sort of North Star to keep in mind as you look forward?
Well, I think I'm going to use the example that Stan used before, because one CFO that we spoke to as part of this research pointed out that Net Promoter Score was a key metric for his treasury team. And I just think that's a wonderful example of having a North Star. This was an insurer.
Net Promoter Score from customers or from colleagues?
From the customer, yeah.
Fantastic.
So it was clearly of interest for them to pay that claim accurately and in a timely fashion, in a way that the customer wanted to receive. And I just think that's, who would have thought? But I think that's a great North Star.
Yeah, I love it. Did you have a North Star or a focus?
My North Star, very similar to Adrian's, would be how can the finance team contribute to business outcomes? And I would encourage finance professionals to think about that, to quantify that, and to build a plan behind that.
Fantastic. Well, you've both been absolutely great. This has been a really good discussion. I wish we had a bit more time, but we don't. So huge thank you to you both for breaking down this topic. Thank you so much for joining me. My first question, maybe I'll fire it at you, Stan. Where can people find the report? Where can people get a copy of the report?
Very easily on adyen.com or bcg.com. And in case you have trouble finding it, just reach out to me on LinkedIn.
And where can people connect and find out more about you and your companies? Adrian, where can people find out more about you and about Adyen?
I think a similar way, adyen.com, or indeed, please look me up on LinkedIn. Happy to have a conversation.
And Stan, where can people find out more about you and about BCG?
So same address, bcg.com, or look me up on LinkedIn.
Wonderful. And you can find me, Benjamin Ensor, on LinkedIn. Thank you all so much for listening. If you like what you've heard, please do follow the podcast. Please do recommend it to your friends and colleagues. Do leave us a review. Let us know what you'd like to hear on the show. If you want to join the conversation, seek us out on social media. Just search for 11FS or Fintech Insider, or you can email us at podcasts@11fs.com. Thank you very much and goodbye.
Ready to transform your career in real time from where you are? Brown University's flexible online master's programs will help expand your business influence and your network in just 16 months. Choose from management, business analytics, or organizational leadership programs that will prepare you for today's most pressing business challenges without putting your life on hold. Scholarships available. Tap to learn more.